Special coverage from the Vancouver Resource Investment Conference is brought to you by Victoria Gold Corp. Welcome back to Soar Financially, and welcome back once again to the Vancouver Resource Investment Conference. We're here on the floor of the conference, and I'm joined by Rule and Matthew Piepenburg. Matthew is with on Greyerz Gold. Still have to get used to the name.
Me too.
And Rick is retired, but he decided to start a bank, so
small.
He's not retired. But he's really active here at the conference, and I'm really looking forward to this roundtable discussion with both gentlemen. Because I picked up the topic they're going to be discussing in about a couple hours here as well, is an outlook 2030. What will the world look like? We've talked a lot, Fed, money, US dollar, commodities to a degree. Let's look forward a little bit and see where things might be going, because that's a big question mark for myself as well. Because we've always predicting these endgame scenarios, and how is everything playing out? Right? So I'm really curious to see what your opinions are on that, and we'll talk commodities, of course, but future looking. So I'm really curious what that looks like. Yeah. Matthew, let's start with you. Yeah. Let's start with the economy a little bit. Where do you see it going in 2030? Where are we going to be? Are we going to be sitting here in Vancouver all hunky-dory, or should we be hiding in bomb shelters?
Well, I don't think we need to exaggerate fear in any case. There's a lot of sensationalism. There's always opportunities in every type of crisis. I'm a total military geek historian. I think declaring victory, for example, on inflation right now would be like, I don't know, Napoleon declaring victory in the first 30 minutes of Waterloo, or Robert E. Lee on day one of Gettysburg. In other words, the battle and the war are not over yet. I see ultimately an inflationary endgame, despite right now a disinflationary period, which is the natural result of rising rates and declining bond prices for a number of reasons. But I think, look, in the next 6 years, we're going to see the inevitable historical movement of currency destruction due to debt. And I think the simple syllogism throughout history is when you have a country that's massively over its skis in debt, 120% debt to GDP, 8% deficits, et cetera, the debt is obvious. The Congressional Budget Office is going to promise us another $20 trillion debt in the next 10 years. So when you have a debt crisis, that leads to a sovereign bond crisis, which then leads to a currency crisis. And they're going to have to, in my opinion, monetize that debt in some way. There has to be demand. If that's not natural demand, it has to come from something. I think that will come from the central bank. They will debase the currency to save the system, and that will be inherently inflationary. So I think right now, as we're all talking deflation and Powell's won the war and the victory dance is being made, I think the net result actually is an inflationary feature to save the system, which in a perverse way could actually be good for stocks over the next couple of years, depending on the nature of the pivot and whether we just have a rate cut followed by QE to the moon. But ultimately, I see an inflationary endgame, which is not the end of the world, but it certainly changes the dynamics.
Then let's throw commodities in there, Rick. Let's talk about that, because 6 years is a long time for a cycle to play out. And 2030 sounds like it's far away, but it might be tomorrow. How do you see that playing out as well, based on what Matthew's also said?
I'm cautious on the demand side for the economy. I need to say, I've predicted 17 of the last 3 recessions. So being a credit guy, I'm always concerned. But I sort of believe that we haven't had a real economic slowdown for a long time. And perhaps as a delayed consequence of an increase in at least nominal interest rates, it wouldn't surprise me to see an economic slowdown. An economic slowdown, we're going to have a very strong market for commodities, simply because of global population growth, an increase in living standards among the poorest third of humanity, and the fact that society has underinvested in extractive industries for 30 years. Meaning, I think that commodity supplies are going to be tight 5 to 7 years out, irrespective of whether we have a recession. If we do have a recession, the impact of that will be muted, because you can have declining supplies if you have declining demand, and prices don't move. I realize that's a convoluted answer, but it's the best answer that I can give. I have zero doubt that we're going to have supply shortages in conventional energy, in oil and gas. Not because of demographics, but rather because of an underinvestment in sustaining capital by the industry, including state-owned industries, of $1 billion a day. I think that we're going to have supply shortages in base metals, simply again because we haven't been investing in productive capacity, and the permitting timelines are extraordinary. Whether or not prices go higher or lower and share prices respond well really depends on the strength of the general economy.
Go ahead.
It plays into that, the economy as well, like this overall, how do you call it, like How do we come out of this cycle? Like we're moving business cycles. The U.S. is almost at the bottom of the current business cycle. Yeah, I'm really curious what that will look like monetary-wise, like CBDCs is a discussion, FedCoin. I don't want to go too far into the CBDC discussion, but I'm really curious what the world will look like. I remember being a young kid, and I thought when I was 18, I'll drive, the cars will all be flying. Right. Hasn't happened. Right. The question is, will 2030 look like 2024? Yeah. And just with a little change.
Oh, look, it's to Rick's point, recession, and it's very important to divorce the conversation or separate the risk asset markets from the real Main Street economy, which, again, very interesting distinction. And a lot of people are thinking, well, if the S&P is ripping, then everything's fine. Be calm, carry on. Again, it's not the end of the world, but I go back to this kind of twist of Shakespeare. The bond market is the thing. And I just don't see an easy way out of that. In terms of recession, I've been arguing all year that we're actually in a hard landing based on old school things like the leading indicators, the conference board leading indicators, money supply changes. But again, those could all be finally debated, but the 4% threshold on the conference board, that was last December. The year before that, we did have consecutive negative GDP, but that wasn't a recession because employment was so good. But then even the employment, the BLS, what it does with inflation, what it does with employment data, we can argue back and forth. It's not exactly honest, in my opinion. That's not meant to be exaggerating or sensational, but there's some questions there. I think in many ways, the layoffs, the bankruptcies, the Oliver Anthony indicator in Farmville, Virginia, all these things to me suggest a hard landing is already here, supplanted or kind of hidden or masquerading behind a ripping S&P that in an ironic way could be further tailwinded by rate cuts, for example. They haven't happened yet, but they're projected. I think they will happen given the debt rollovers on the S&P, given Uncle Sam's need to reprice debt over the next 36 months. So I do see the rate cuts as inevitable. I do this time. I was wrong last year after the regional bank crisis. I really thought that BTFP stood for buy the frickin' pivot. Like that was going to be that. The rate cuts were going to happen. And Powell, to his credit, is in some ways acting more like Volcker than I thought he could do for long. But again, I think in a lot of ways we are already in a recession. Will that recession deepen or be hidden by a Fed-supported centralized S&P and Dow and NASDAQ? These are questions I don't have all the answers for, but I don't see how you can postpone constructive destruction by having a centralized economy with centralized S&P. But that S&P bubble is benefiting the top 10%, not the bottom 90. What happens to that bottom 90? What happens on Main Street?
Well, I look at Japan, and I keep bringing that up in almost every conversation lately, because they're sitting at a 250% debt to GDP level. Rick, in your opinion, is the U.S. headed the same way? Are we just kicking the can down the road? Are we going to have the same conversation 6 years from now?
With the caveat that I am not an economist.
I know. That's why I was cautiously debating whether I should ask you that or not.
I mean, I'm a credit guy.
Yeah.
Okay, that's really what I am.
Weird.
And when Matt, to his credit, talks about debt to GDP, unfortunately, he isn't painting a bleak enough picture, because he points to the on-balance sheet liabilities of the U.S. government. What concerns me more, perhaps because I'm 70, is the off-balance sheet liabilities. If you add back the net present value of promises society has made to each other, Medicare, Medicaid, military pensions, Social Security, according to the congressional budget, not some cranky, fat old libertarian, the net present value, not nominal value, but net present value of those obligations is $120 trillion. And you try and service that debt with a demographic that gets older every year and a budget that's $2 trillion in deficit. Sometimes I'm happy that I'm not an economist. As a credit guy, what I would say to a borrower that was $140 trillion in debt and was enjoying negative free cash flow of $2 trillion a year is start saving. And it's very difficult for me. I mean, I understand how you dig your way out of this. People your age, Kai, say to people my age, you guys voted yourself all this cool stuff and you forgot to pay for it. So you pay for it, because we're not gonna.
Okay.
Politically, it's probably not palatable to end Social Security, Medicaid, Medicare, military pensions, and the Environmental Trust Fund. But X that, it's very difficult for me to understand how we dig our way out of this. I'm concerned that my countrymen aren't good enough at arithmetic, or whatever their shortcoming is, that they don't understand the drag of the net present value of entitlements on the economy that my generation leaves to your generation. And it ain't pretty. People talk about the wealth effect, how the baby boomers are allegedly going to leave $120 trillion, or $140 trillion, pardon me, in inherited wealth to the next generation. They're also leaving them $146 trillion in debt, meaning that the net transfer of wealth is negative. Now, it goes to different people. You know, there's a whole bunch of rich old guys like me that are going to leave lots. And then there's everybody else who are going to get left a donut. And those who get the donut are not going to be happy.
Yeah, I think that's a really important point, Rick, this off-balance sheet debt, you know, that kind of is ignored in the 120 or these other deficit numbers. And it reminds me of a kind of a cryptic comment that Luke Roman recently made. He says, well, we could cut entitlements by 40% or military budgets by 40%, but that's going to be political suicide in this Western hemisphere. And maybe in Argentina, you could take a chainsaw to some of that and get away with it because they're so desperate. And in America or in the West, you're not going to get elected on that kind of honesty or that kind of constructive discussion.
Let me jump in there real quick. Are we not desperate enough yet?
Well,
are we not hurting enough? It doesn't look like anybody's hurting enough.
Who's hurting?
That's what I mean.
Right.
Like, are we not desperate enough?
But again, this is fat rich guys in the top 10% making credit discussions that are somewhat esoteric, but on Main Street, they're listening to Oliver Anthony play the guitar and say, my dollar ain't worth, and I'm taxing no end.
Let's look at economic indicators, look at job loss numbers, and like it doesn't look like we're hurting yet. Like, yeah, of course, credit cards are jumping up, credit card debt is jumping up, it's higher, but is really anybody screaming it? Like,
well, that's in German, ausstehen Augen, ausstehen Sinn, out of sight, out of mind, right? The Fed does a really good job because on that trilogy of, you know, debt crisis, credit crisis, currency crisis, then is a centralization crisis. And part of that centralization is messaging. This sounds conspiracy theory, but messaging control, what's not discussed, what's omitted from the daily dialogue and the mainstream media or even in the alternate media. Well, what's omitted are these hard facts on the ground. Let's just ignore them. Let's be calm and carry on. As it builds resentment, that's hard to quantify, mistrust, whether it's on Main Street, whether it's with the world reserve currency, whether it's with weaponizing, whatever debate you pick. It could be geopolitics, could be crypto, could be currencies, but there's a growing distrust that's somewhat palpable. But can we cut spending? Can we cut entitlements? Can we cut the military? Can we do it like with a chainsaw in the West? I don't think so. So we'll postpone, go further and further into debt, and debase the currency. And Rick has always said, I don't want to see gold. I buy gold because I'm afraid it's going to go up. But I think deep down, Rick, you know it's going to, well, you don't know. I'm not going to say you know, but you feel like it very well could go up. And it's not so it makes you richer. It keeps you from getting poorer. I don't know. That's
in terms of my motivation, that's exactly correct. I buy gold not because I hope it's going to go up, but rather because I'm afraid it's going to go up a lot. Right. And that whole, I'm a very happy 70-year-old fat rich guy. I don't want my standard of living to change. I don't want the gold price to go to $8,000. I don't want the whole set of circumstances that would cause that to occur.
Right.
I'm afraid it's going to, as opposed to, when I talk to people here on the floor, and they say they can't wait for $5,000 gold.
Yeah, careful you ask for it.
Yeah.
Think this through, pal.
Yeah. Seriously, somebody's got to rip that band-aid.
Yeah.
Right? So we have U.S. elections this year as well, which is, of course, globally probably the most important one because a lot hangs on it. We've had Taiwan elect an election this year as well, which could be geopolitically interesting. But the U.S. elections, like, I don't want to debate, I don't want to get into politics or anything, but we need somebody who rips the band-aid.
Well,
Do we see that happening?
I think you could elect Santa Claus, you could elect whoever. They can't. No one can solve this problem easily. It would require a Javier Milei type of blunt, radical, which I don't know how that comes in naturally through our electoral process, whether it's red or blue or in the middle. I don't know what you think, but I don't see anything.
Your thoughts on that? Because 4 years we were talking 2030 outlook 2030. There's 4 years of a new president in between, from was it 25 to 29 or something like that. So
two great quotes, Kai. One. Politics, defined by understanding the root words. Poly, from the Greek, for many. Tick, from the English colloquial, for small, blood-sucking insect. The process is understood. A better one was Mencken's. Elections are best described as advanced auctions of stolen property. Citizens organize to become high bid, to impoverish their neighbor and enrich themselves. And there's no end in sight. Can you imagine a nation that created 24% of the world's savings and investment assets, the United States, having a choice between Biden and Trump?
Yeah, right.
It's difficult for me to understand how anybody could be for either of them. I could understand voting against either of them. That would be easy. But the idea that a country that's vibrant enough that they still, after all the years that they've tried to wreck it, comprises 24% of the world's savings and investment assets, having a choice between Biden and Trump is incomprehensible to me.
It gets past the political or economic issues to actually philosophical Pollyannish issues, but this Kennedy quote of profiles in courage. Whether he had it, I don't know. But can we have an electoral scenario where you have choices between people who generally worry about the state of their country more than re-election, or vanity, or income, or popularity? And that requires the kind of courage to not be popular, to discuss things like family members do around a table when they have more debt than income, and the Porsche isn't going to be bought, or Exeter or Choate are out of the equation this year, or the second home isn't. In other words, can we be honest with each other? I think Americans could tighten their belt and come together as they've done in the past if they trusted their government, their system, their currency. I think that trust is palpably absent today. That's why we have opportunists who you could argue are more interested in power than in the country. But again, don't want to split hairs on that. Again, so my answer is, I don't think there's an easy answer. We actually need some real constructive destruction, some real transparency, some blunt understanding of debt. And I don't know a politician can get elected on that. And is that the fault of the politician or the population that doesn't want to educate itself and demand that? It's a vicious circle.
Let's talk about, you're saying you're a credit guy. We've got $17 trillion in debt that needs to be refinanced in bonds over the next, 36 months, something like that. What would that look like? And what will that look like in 2030 as well? Like, how is that even possible? Regardless of who the president is, let's leave that out of the equation. But what kind of environment would we have to refinance it?
A lot of confidence left. It'll get done in the near term. I have zero doubt. I mean, the idea that the bond market didn't get waxed worse with a doubling of nominal rates astonishes me. I'm delighted to be astonished, believe me. I'm really happy to be astonished. Would I buy a U.S. 10-year Treasury? No way. I'm a credit guy. Right. They're paying me 4% in a currency where the notional CPI rate is 2.8, where I think the real deterioration of the purchasing power of my US dollars is more like 7% compounded. The idea that I would take a negative 3% yield in favor of a creditor that has $146 trillion of liabilities.
Wow.
I mean, come on.
Who wants a declining asset for bad credit?
There's still the risk of default as well.
This is like arithmetic.
Well, the thing is, they won't default. And so what I see, to your point, because I completely agree, we're kind of just yes-sayers, but I see a future in the next 6 to 10 years of extreme negative real rates, regardless of what the BLS tells us what the CPI scale is, which is an open fiction on Wall Street, but that's not a conspiracy theory. And this was a conversation with Russell Napier years ago, before inflation was the topic du jour, who was a staunch deflationist before he not because I changed my mind, but he saw it. Matt, every debt soak regime needs negative real rates to get themselves out of debt. So we're gonna have negative real rates, regardless of what the official CPI scale says. That means more currency debasement. So we can continue this charade at the expense of the purchasing power of our currency, the value of the fiat currency. And that will ultimately affect the middle class far more than, even though it hurts and annoys us, it debilitates them. And so that social unrest component of this comedy we're playing with our debt levels, our credit markets, and our currency, that social unrest is hard to predict and quantify and objectively determine what is unrest. Is it January 6th? Is it identity politics? Is it the rise of X or Y leader? Will it be clean before then? I don't think we're going to see pitchforks. We could just have a very dumbed down population that's told to be afraid of something else while we continue this ridiculous credit expansion that we can't afford.
Do you see a massive default in the next 6 years?
Oh, yeah.
I think there's a possibility, maybe not a probability. I think there's a possibility of a liquidity crisis. I think there's a possibility, given how much volatility we'll face, that there is a black swan out there that causes a liquidity crisis. If it were going to happen, my suspicion, the thing that makes me most nervous about, by definition, you don't see a black swan, right? But the thing that makes me most nervous is junk corporate debt. And the holdings of several $1 trillion in junk corporate debt in ETFs, where the superstructure is very liquid and the underlying assets are illiquid. If you had a circumstance where there was concern among the population and credit quality, the junk bonds started to sell off. People started redeeming ETFs. The manager won't be able to sell the underlying security. And that would be truly, truly, truly ugly. And I'm not sure I think that that's a probability, but it's a strong enough possibility that I'm chased all the way out of the high yield market, even for credits that I know and like.
Well, because that black or gray swan, because a black swan you can't predict, there are so many potential needles at this debt balloon. What will be the trigger of the predominant needle 6, 10 years out? It's a mug's game to predict, but the vulnerability and the risk is so heightened right now, and so out of sight, out of mind, and so politically ignored and media ignored. Again, I don't think we'll have a default. It's impossible, because we can always monetize that with synthetic liquidity. And even if there is a liquidity crisis to the nature that Rick's discussed, we'll find a way to come up with artificial liquidity. But again, this goes to the original point. You will save the quote-unquote rotten system by debasing the currency until there is some type of revolutionary event in politics.
I can't shake the feeling that we're going to be sitting here in 6 years, we're going to have the same discussion, only with a couple zeros at it.
Yeah.
The most important takeaway, however, for your listeners is that they don't have to be as stupid as their neighbors.
Right.
You have to have liquidity on your own balance sheet. You can't play the same complacent game that you played for the last 40 years. I'm not trying to say that you should lie in fetal position in the corner and admit defeat. But you have to understand that the arithmetic surrounding you has been less benign than it's been for the last 40 years. And irrespective of what the big thinkers do, which is almost invariably going to be stupid, you don't have to be stupid. You have to organize your life in a way that makes some arithmetic sense. Yeah. I think the quote was, you don't need to lose your head when everybody about you is losing theirs.
Right. Yeah. No, it's a really interesting point. The flip side is, it's like Henry Ford said about, if you understood banking, there'd be revolution tomorrow. It's just, I think if people understood credit markets better, if they self-educated, I think they'd at least be more critical electorate then. They'd be asking the tougher questions and imposing tougher conversations. But that's asking a lot of the Pareto optimality, the 80% that wait for the 20% to save them. But I think if people actually understood the fundamentals of credit markets and the fundamentals of debt, and it is so important. And I think that's not impossible to do, but will it happen? And will that force a tougher conversation without having to have pitchforks? I don't know.
It'll be tough. Rick, you mentioned earlier, and maybe that's sort of the last question as well, coming back to the conference here as well, lack of investment in the extraction industry. Do you see that changing at all over the next, let's say, 12 to 24 months? Because I don't dare predicting any further than that.
I think in the junior market, this is going to be a very good year. You have, for the first time in 12 years, you have really good pricing, and you have an audience that's ready to take advantage of really good pricing.
I've been hearing your name thrown around a few private placements the last 2 weeks as well. So.
Yeah, I mean, I've been priced out of the market for 12 years. For me, if I looked at the juxtaposition of risk to reward between the space that I used to inhabit, which is the juniors, and the more senior companies exhibited much, much, much better ratios of risk to reward. And we were in such a speculative environment, such a narrative-driven environment, that dumb money chased out smart money. The dumb money has gone to money heaven, which is where it rightfully belongs. And so now there's room in the space for some smart money to come back. I think that's useful. I would argue that the extractive industry has been over rather than underfunded for most of my career. I would argue that the bane of the gold industry has been that its cost of capital, its real cost of capital, has been sub-zero. If you define the cost of capital as being relevant to the premium to net asset value that equity capital has been raised at. Traditionally, the gold mining sector has been priced at about twice NAV, which means that anybody who is able to raise any money at 2 times what their company is worth has a negative cost of capital. So I would suggest that the bane that the industry faces is not the presence of high cost of capital, but rather a history of low cost of capital. And I think that has incented truly insanely stupid investment allocation decisions, which is why the industry is held in such disfavor.
No, listen, I mean, Rick has forgotten more about mining than I'll learn. I'll walk over and I'll learn in my lifetime. So but I think I have to keep it simple too, because I'm not a mining guy. But I'm going to quote him to answer my own question, because Rick said this about silver, but I think it's true with the value play right now in juniors. And again, I'm not an expert on juniors, but it's common sense in a sense to me. But he was saying silver rewards infrequently but extravagantly. Right. But I also think it's going to be true of junior mining. If you have the patience and you understand what everyone taught us and no one does is buy low and sell high. But you have to be patient, you have to look for value, you have to understand the dynamics behind these balance sheets and these opportunities, stupid money and smart money. And I tell my daughter, just, is in Goldman, just figuring out how it all works. But I said, Dave, just buy some junior miners and don't look back, you know, and buy the right ones. And that's where, I mean, come on, Rick's, we're all just, you know, when it comes to that space, I'm not going to get advice on names, but I certainly like the space.
Fantastic. Gentlemen, really enjoyed the conversation. I loved how dynamic back and forth it was. Really appreciate your time.
Great.
RuleInvestmentMedia.com for stock. Do you still do the stock portfolio reviews?
Anybody who cares what I have to say about the junior resources, go to RuleInvestmentMedia.com, list your natural resource stocks. I'll personally rank them. Please, no pot stocks. Please, no tech stocks. Please, no crypto. Let an old guy do what he does well.
Yeah, that's
We've
fair.
had more of you, Matthew, as well.
Well, again, we're now Von Greyerz instead of Matterhorn, so even I have to get used to the new name, but it's the same team, same thing. We just changed the name in honor of our founder, whose values we admire. And we're at vongreyerz.gold and still at goldswitzerland.com as well, but all our thoughts and videos and interviews like this will be out there at some point.
Fantastic. Awesome. Gentlemen, thank you so much for your time. Yeah. Everybody else, thank you so much for tuning in. I truly hope you enjoyed this conversation as much as I have. Make sure to follow these gentlemen on their websites, on Twitter. You're not on Twitter, but you're on Twitter. So
I've heard that.
Yeah.
I can barely use a cell phone.
Sounds somebody by the handle of Real Rick Rule, so I'm not sure if somebody's just impersonating, but commentary makes sense. And make sure to follow us as well. Hit that subscribe button, and we'll be back with lots more. Thank you.